Good afternoon, everyone, and welcome to the Pure Finance Investment webinar, Navigating Uncertainty. My name is Eoin Wilson. My company is Pure Finance. I'm a financial advisor. I'm here joined by David Walls from Zurich. He's the head of investment sales in Zurich Life. So today's webinar is really about giving you an investment update on the stock market, on the bond market, to talk about the impact Donald Trump is having on the overall market. It's also to talk about the importance of long-term investing, and also to try to remain, which is really difficult to do, to remain calm in in a difficult period. I just coincidentally had a webinar, or I'm holding this webinar on the hottest day of the year. So thank you for joining us and not having ice cream today. So I'll just begin the webinar anyway. So thanks for joining us. Just talking about Donald Trump, on the 2nd of April, he announced Liberation Day, which is really to make America great again. People are probably really well aware of this already by watching the news. He announced extensive tariffs across the world, China being hit really badly. And Trump just basically wants to have more trade in America. He felt that a lot of the trade was unfair to American companies. Initially, tariffs were really high across the world, but on the 9th of April, he decided to take a pause on his tariffs. So there's only 10% tariffs around the world, and China is going to be hit with 125% tariff. So this has created economic turmoil to the stock market, but also to the bond market. So just on the right here, you can see all the different tariffs, but they're all going to be 10% except for China. So this next slide, I'm going to ask David to talk about how Trump decided to calculate the tariff. So over to
Sure,
you,
yeah. I as you know, Owen, I'm no masters in economics myself, and I might rob a line of I'm a sometimes fan of David McWilliams, who presumably everybody knows, but he did a piece earlier this week on this, and he did say, as a lecturer in Trinity on economics, he would fail anybody that came in an exam that came up with this way of calculating sort of trade deficits, or why you should put in formulas. So it's very simplistic. It takes all sorts of it's just kind of not the right way of doing things. I said I won't go through it, and it can be quite punitive on the wrong countries. So, like we were talking earlier on, you pointed out that some of the South Asian countries are being hit pretty hard, and why would that be? And it's, it genuinely is kind of mad stuff, in that if you are Bangladesh, as we've taken an example of there, if you're Vietnam, you are very poor countries with very cheap labor, and you're making stuff cheaply to export it to the US. US stuff that they export is expensive, and these countries don't have the means broadly to buy US goods, and therefore you get this trade deficit for natural reasons, because the US have outsourced to this cheap labor, and now he's kind of going, well, all the words behind it. So, quite simply, Bangladesh, Vietnam sell lots of primarily clothes, lots of cheap clothes, and they don't buy Harley Davidsons and expensive trucks.
I can't imagine how America are going to be able to produce these goods for the same price.
They're not. So part of the madness.
Yeah. So this next slide was interesting, Dave, when you sent it across to me there during the week. People are probably really familiar with the NASDAQ index, which is predominantly the tech stocks. So you can see there they dropped by 10% since the start of the year. And then the S&P 500, which would be the top 500 companies in the US, that's also dropped considerably. But you might tell us what the Russell 2000 index is, Dave, and
Yeah, I mean,
why has that dropped more significantly?
yeah. So look, as you know, we did a webinar to about 1,200 brokers yesterday. We have borrowed some of the core slides, from that as we put some work into it. And our kind of point here was, look, here's three broad indices of the US, and they are taking quite a bit of a kicking. The Russell 2000 is the broad, so the Nasdaq is about 50% tech, so it's very tech heavy. The S&P is, as the name suggests, 500 broader, but it's 500 particularly large company. And what you get with the Russell 2000, it goes out to 2,000 companies, and it gives much more of a focus across the broader market. So I wouldn't call them small cap per se, but there's a much broader average weighting of size of businesses in there. And what kind of happens is, in a flight to safety, we could probably will touch on, people go to bonds, people go to gold, but even within equities, there you get a bit more resilience in the big, steady household names that, people tend to drop their smaller cap stuff. They tend to sell off a little bit quicker. It's nothing more really hugely scientific than that.
So would you say the smaller companies might not be able to manage all these, these more, I suppose they're more difficult trading conditions, really. The
Yeah, there. Look, as I said, we could go well into this.
we
It,
don't, I suppose we shouldn't go well into it, but yeah,
yeah,
just to get you.
exactly. So there's also a more domestic focus. Now, in theory, that the tariff stuff should benefit them, but the reality of it is that, lots of sectors or companies within this are importing an awful lot of parts and stuff for their businesses. So it's just not as simple as a particular president is trying to make it sound.
Okay, so this is the VIX index. So this is a useful I suppose chart to just show you, it basically measures the fear, so it measures the
It measures the
volatility.
volatility, the amount of trading. Yeah,
Yeah.
you're right on. We'd call it the fear index, although the official name is the VIX. And what happens is, in periods of short, sharp fright, you get heightened volatility. And we're showing there that in the end of last week, you were not quite, but getting up to nearly COVID levels of trading and fear and volatility.
Sense of
So
panic. Yeah.
it's not a good thing. You don't want that spiking, and
Yeah.
it's
No, but
probably the worst time to sell as well, as history has told us. 2008, Q1 2020, and probably last week, this week are not great times to get out of your equity portfolio.
yeah, yeah. I suppose what it also shows is that, the stock market just doesn't go nice and calmly across the board, across it doesn't have a nice line.
No,
It is very volatile. Okay.
yeah, I mean, the 5-day moves were common many years ago, but as the market itself has actually got bigger, we have found that it's got a little bit flatter in percentage terms, and what tends to happen there is um people now see a 5% move. It used to be roughly, we used to say you tend to get two 10% moves and one five a year, and 4 to 6 5% moves. Now somebody sees a -5, it can be a big panic and whatever. And it's important to stick with the program, as we'll touch on again.
I'm having technology issues here. Apologies.
It seems as when you try to um
I'll just do it this
can
way.
we answer people's questions as they bother to put them up? And as you're having fun there,
Yeah,
I
no,
think I probably would.
I'll just do it this way.
Um,
It's probably easier.
to,
So,
to the
so this
person
is
who
the
just to the person who just asked, would this be a good time to buy the dip? That's an interesting question. I'm spending most of my time trying to stop people selling and losing the plot and the plan and brokers at the moment. So it might well be. Having said that, there is likely to be some volatility around for some time. So we clearly don't know where the bottom of the market is. but I'll reference a quote from a US journalist that I like. It's not the much used Mr. Buffett, but he has a good line that says, the stock market is the only market I know that when the goods go on sale, everybody runs out of the shop. I'm glad to see somebody there is thinking, well, maybe I'll wade through the crowd exiting the shop and I go in and pick up some bargains. So, look, good quality equities.
I heard a good quote there from JP Morgan there recently, Dave. He said, in times of panic, JP Morgan used to say that stocks go back to their rightful owners. So, I mean, that was an interesting one as well. So this slide here, Dave. So this is an intraday volatility.
Yeah,
So
so
obviously on the
this
7th of
is what
April, there was a huge amount
this
of
is on
volatility.
what's driving that VIX index. We're literally, that grayed off area is an hour of trading the other day, and it's actually what we now know was famously a fake tweet came out to say about the 90-day pause. Turned out then ultimately to not be that fake, but the market just literally reacted, up about 7 or 8% in a couple of minutes. And within a period of time when people were questioning the validity of that information, it fell off again. As we know, then on Wednesday it rocketed up when it was actually confirmed that there is the 90-day pause. So you get these huge swings and movements, even within an hour.
So I like this slide that you sent on earlier this week. So obviously the biggest crash or the last 50 years is obviously Black Monday in 1987.
I even remember it.
Do you remember it? I suppose I've only been giving advice since 2008. I started giving advice in 2008, which was a difficult
You didn't
period.
cause the crash though. It wasn't your fault.
I don't know. Meeting customers for the first time, telling them their pension had dropped. But I suppose Liberation Day is kind of in between 9/11 and COVID-19. There's on average around a 10% drop.
Yeah, I mean, 9/11 wasn't an economic thing. Markets closed. There was a bit of adjustment and there was stuff going on, which was just terrific. Interestingly, when COVID hit, Owen, I'm not fielding nearly as many panickers or people with issues or fear as we were now, because people were literally worried about particularly their parents' lives and their relations in nursing homes and stuff. It didn't really seem to notice their pension fund had come off by 15 or 20%.
Fair enough.
So I mean, it's a serious event, I think, is our point there, Owen, and it's something we're taking very seriously.
This was also another interesting slide that we were talking about, Dave. And so this is basically the intra-year falls. I suppose as investors,
it's your worst peak to trough in a calendar year.
Yeah. So the red dots are basically the decline in any given year, and the blue is the positive in the year. So these are for European equities. And I was talking to Dave about 2020. So in 2020, which was obviously COVID, the stock market dropped, or the European stock market dropped to 34 or by 34%.
Yeah.
But by the end of the year, it was up.
No, it was down 4.
It was still down 4, but it went up to -4, which is
correct. This is the point exactly. It's the worst peak to trough, but in a year where people are getting nervous, and then where the calendar year returns actually ended up. In fact, if that was a global, which I couldn't get my hands on, if that was a global picture, global stocks ended up in 2020, as you probably remember, but Europe ended up a small bit off. But the point is, again, it's back to the don't panic. Stuff recovers. It always does. And there's a point in time when it feels very painful, but the market and funds and valuations will recover.
It's really to just stay invested. That's the key point, isn't it, really? Because, I heard from another broker, or from Zurich, there are other brokers out there where they sold client portfolios, and then they missed that huge surge earlier on in the week. And, the stock market was
been
up
involved
10%.
In trying to persuade people, and one person they couldn't, with a very large ARB sold last Friday, felt clever on Monday when markets fell again, and then missed the 10% bounce on Wednesday,
Yeah,
as they'd
so it's
lost
good.
about 100 grand and missed getting back about 200 on Wednesday. But
Okay, so this is the COVID downturn. I like the slide, Dave. It basically shows you the difference between the people that stayed invested during, the stock market turmoil during COVID-19. So if an investor stays the course, since COVID, they would be up 46%, but the person that switched to cash would actually
yeah, these
be,
were based on real policies we picked out. Yeah,
is that a minus 10?
the which
Is that minus
it's
10
actually
there?
minus 10. Yeah, because for most of the period till
Yeah.
then, the cash returns were negative.
That's true, yeah. With deposit rates, yeah,
Yeah,
earning nearly nothing. And the person
so
that
that
tried
that
to, I suppose, tried to temporarily switch from the stock market back into cash and then back in, the average was 16%. So it really just shows you the importance of investing for the long term and not trying to time things.
explains the plan. Correct. Yeah, yeah.
Okay, so this is what everyone wants to hear, Dave. So, how are Zurich managing this process and
Yeah,
how,
we're going to keep this very light. Yeah,
okay,
look, how we most I was on a call earlier this morning with someone who was just talking about they're not risk averse and they're 100% in equities. They're not worrying. They were just talking about long term about equities. But most investors with us, and pretty well all the business you do with us, and presumably with other houses as well, is most people use multi-asset funds or a managed type fund, which spreads the risk and diversifies across equities, bonds, cash, property, alternatives type of thing. And just our process, I think our key point on this process is, and as our CIO said on that webinar yesterday, we've had some form of this slide because this has been our process. Many of your clients, Owen, I assume, as your South County Dublin, probably know Zurich's shiny new head office. In BlackRock, we've been actively managing client money through this type of process for over 40 years. The snazzier looking slide is the only thing that's really changed. And the point is, we start off with what's going on in the macro in the world. And obviously, at the moment, it's nearly all about the macro. Citibank's numbers will be out later today. No one's really watching them. They're far more concerned about where the dollar is going. And by the way, it's a good chance to buy a few dollars if you're going to the US in the next few months, or certainly best it's been in a while, at about heading for 114 today. But look, that's the process. I won't go through every step. I want to
I
presume people can
suppose.
get these slides. Pardon?
Yeah, no, I suppose what's important, I mean, I'm obviously an advisor. Have a lot of clients with Zurich, but I'm also an investor with Zurich. I have my own pension, my own savings fund through Zurich Life. But I heard you were telling me earlier on in the week, I suppose from an investment perspective, you do tilt things. So you are buying more short-term government bonds. You're maybe switching out of American equities, buying more European equities. So there are ways that you're kind
Absolutely. Yeah, and
you're
that's
you're
the
you're
active
you're
management.
trying to get the better value, whatever asset it might be. I was at your lovely shiny new offices there recently, and Dave Warren, who's your head of investments, was saying, you're even putting a portion into gold. So you have, I suppose, a really
Yeah,
worldly approach to your investment, whether it's by country and but also by sector, but most
and then
importantly,
within
also
stocks
by
and
asset
commodities. Yeah,
class. You're
yeah.
you're all yeah, yeah. So it's and
Yeah,
you
so
you said
depending
you
on what's going on in the wider world and currencies, etc., that will lead us to our preference for equities, bonds, cash, whatever. We go down then into our preferences within equities, say for regions, for sectors. Do we like IT? We've trimmed that back a bit recently. We've added to financials. We've narrowed that exposure to IT, and into a bit more sort of. So the book's got a little bit more defensive over the last week or so. So yes, we've sold down equities a little bit, and US equities particular, giving us a bit more of an overweight in Europe and a bit more underweight in US. We've sort of taken some out of IT and put some more in financials and in utilities. Again, healthcare, things that are a little bit more defensive, not row growth stocks. And as you said, we've put most of those into those sales in equities into short dated bonds. Also key to note for those that are interested, we are of the view that the European bond markets, both sovereign bonds, government bonds, and corporate bonds, which we also use, they're large enough and liquid enough for our requirements in Europe, and we only use European bonds. So there's no currency exposure within the bond book. So, for example, US Treasuries give you a higher yield, but this week the last 3 weeks, it would have killed you on the currency. We don't see the need to introduce in the more conservative bond portfolio. We have to in the equity book. You've got to have you can't be all Eurozone equities.
Okay, so this just gives people an idea of, how Zurich have performed since 1990. Am I right in saying a euro would be worth a euro back in 1990 it would be up considerably in 2025.
Yeah.
And obviously we've dealt with a lot of, I suppose, difficult periods since then, but it's been an upward trajectory.
Correct. It's the old left to right, and anybody that invests is joining that line at the end of the line at a point in time, and you never know exactly where that's going to be. We're also very proud on that slide, Owen, of it actually needs to be updated because we won it in 2024 as well. I think this does resonate with people, and this was in an ad of ours recently, and the amount of people I know, both professionally and personally, that said it back to me was, you work in a multi product environment. There's 7 or 8 people, 4 other large life codes and other product providers of whose products you can sell, and yet your body, Brokers Ireland, has voted us their preferred, their winner of their Investment Excellence Award for 10 years in a row now. So as we've got competitors out there, the broker independent advisor market clearly sees Zurich as their preferred, pension and investment house, and have given us that award, which we're very proud of, against a set of competitors 10 years in a row now.
No, I have to say, a lot of my existing customers are very happy with Zurich, and I always find the litmus test is actually, okay, let's look at your pension. I might have a customer from 10 years ago. What is it worth now? And the litmus test is, has it grown? And generally, it has,
I think
99% of the time, or sorry, I should say 100% of the time, Dave, with Zurich, it's always up.
well,
for
probably with
a
others
period
as well.
of longer than 5 years anyway, it's still up.
And I think you've passed the litmus test inadvertently already. You've already stated, which it wouldn't be my place to be, that your own pension fund is with Zurich. So I think that says a lot.
There's no GDPR with me, with my own stuff.
Yeah.
So I suppose to summarize your own view on, I guess,
And look,
the markets,
I think,
which is a really difficult question, but may as well ask.
I mean, those points are there. You'll make the slides available. I think it was summed up in a couple of lines by our CIO yesterday. I thought this was a brave line because it's just perfectly honest. On a call with 1,200 advisors who are our clients and who give us their policyholders' money. And by the way, David always refers to the policyholders' money and outcomes for policyholders. That's what he gets up in the morning. David Warren, CIO, does. He's looking after. He says, "I'm looking after people's retirement, their kids' education, their kids." And I take it seriously. And probably nothing annoys him more when people ask us why we don't do cryptocurrency. It's not appropriate for what we do. It exists and people invest in it, and that's fine. But look, David's line was when he was asked, is this a cyclical event or more structural, i.e. long term? And his answer was, I honestly don't know right now. And that's why we're in a period of doing some work, waiting and seeing. We will make decisions at an appropriate time. We still have the same process. We still have the team of 18 fund managers, have all their inputs, have all their meetings. And what he's saying is, look, right now, I don't know. This could be, a structural event, i.e. change the standing of the US and financial markets considerably, for some time. Or in 2 months' time, we'll be looking back at this and people have stopped talking tariffs or whatever. But when, as you said, when the bond market blew up, it's one thing about equities, but, the bond market is telling you is that people have lost faith in your financial system and your country, Yeah. So sorry. So to go back to what we have the ranges that we can manage. I've said sold down equities to the middle of the range. So right now everything's we're not really got in any particularly active positions. Equities not at the upper end of the ranges. Within sectors, we're not taking strong positions against the index. right now it's a bit of a wait and see. We think there'll be volatile markets around for a period of time, certainly weeks, possibly months, and we will be making decisions as we see fit along the way. But right now, we're working through our process.
And do you have US government bonds in your portfolios?
No, no, all our bonds are eurozone.
Okay, okay, because obviously recently, government bonds in the US have been hit, and there's a question mark over them
Yeah.
at the moment. Okay, so the next part of this, I suppose, webinar is just a few principles and a few fundamentals that I just like to show people. So this shows you the return since 1970 of the global stock market, and you can clearly see there's been 40 years of positive returns and 15 years of negative returns. So I think what's really important at this point in time, which is really difficult to do, is to try to be more calm, zoom out, and try not to watch the financial news every day. I think that's really important. We went through COVID, which was a unnerving experience. We went through the financial crisis in 2008. Dave went through Black Monday. Thankfully, I was only 5 years of age when that happened. So it had no impact on me. But yeah, so I mean, I think the important point on this slide is, there have been way more positive years than negative years. And then overall, when it comes to your pension, you should have more positive years. This is another interesting slide. So if you started investing in 1970 with a euro in the global stock market, it would now be worth 61 euro. And we've gone through all these different crises. So, I mean, there tends to be a crisis every couple of years nowadays. So just go with the flow. This also shows it's just another graph showing that the importance of investing over longer term. If you start in 1994 and invested up until 2024, the global smaller companies would have done best, and then big global cap funds were second best. And then you can see the difference between the other emerging markets were a bit lower. I really like this slide. So reacting when it comes to investing can really hurt performance. I remember when I started giving advice in 2008, I thought you could time the stock market. That was me naively thinking that you could time the stock market. But if you look at this, if you just remained invested between 1990 and 2024, you would have produced a 10% return in your investment. But if you had missed 25 of the best days between 1990 and 2024, your average investment return would drop to 5.8. So that's really critical when it comes to investing. If you miss the best day, and that's where I guess the philosophy when it comes to investing and why I say it's important to invest over a long period of time and not try to guess the stock market. It's because if you miss the best day, it could really, really impact your pension over time. Okay, so Dave likes this one. He calls this, what do you call it? The quilt? The
That's your granny's quilt.
Diversification quilt?
Your granny's quilt.
Oh, my granny's quilt. Yeah. Not sure my granny would know much
What
about investing, but anyway.
what pattern can you see there? It's not a trick question because the answer is none.
Yeah. So it's interesting.
And that's kind of the point.
Energy is doing the best at the moment, and you can see what tech is doing the worst year to date.
Yeah. So look, the point is that the diversified portfolio across the middle is the place to be. Like in any given year, there will be a jumble up of what sectors, and the sectors are things like industrials, financials, consumer staples. When you get a market wobble, gold as well, and things like consumer staples, because people go, hey, people will keep buying bread and maybe having a cold beer on a sunny Friday, and they're the staples. They can't grow by 30% per annum because people don't consume 30% more. But so look, the market is a random thing. I've dumped a little name actually into the chat there, a fella called Carl Richards, and I don't know if you've ever seen him on. He's a great thing talking to your last slide called the investor gap or the behavior gap. Sorry, behavior gap, and he's a book on it. He's a US advisor basically, and he does great cartoons and drawings and things. He's an interesting man. But
He's
the behavior gap is what the stock market did over 30 years. And the gap then is what the average investor did over the same time frame. And the good thing, and the thing is they interfered, they got out, they got in, they got out, they got in, and your average investor ends up costing them money. And the good news, ladies, by the way, from financial behavior is females are better than men with making a plan and sticking with the plan and not getting all testosterone and I know best and I'm going to play the market.
okay. So I suppose in conclusion, my views and the views of David would be, it's important to stay disciplined, just stick with your plan. Cash isn't the long-term answer. It's about time in the stock market. Unfortunately, volatility is part of investing. I was watching a famous investor there recently. He said, the price you pay is the volatility. So they call that the risk premium. We're going to have to go through volatile periods for you to earn that extra return in your pension. And unfortunately, that's the price you pay. Over the long term, risk is rewarded. And finally, diversify, diversify, diversify. I think that is a really important one. I've seen people that put all their money from their pension into Bank of Ireland shares or AIB shares over the last, 10 years ago, I saw this. And, you don't want to be investing in one area or one sector. You want to invest across the world. So I'd like to thank everyone for coming to this webinar on this really hot, sunny day, and you're not having ice cream or beer, or as Dave said, playing golf. But if anyone has any questions, feel free to ask us a few questions or
Yeah, while people are thinking about that, Owen, I'll just say one thing on that volatility part. When you're an active manager of multi-asset funds like we are, we actually always see volatility as an opportunity. As one of your people asked already, now we're not currently taking the opportunity of buying equities a bit cheaper, but volatility and price movement, it is an opportunity.
Okay. Yeah. No,
Does anyone want to ask any questions outside of the chat box or? The last quote that I have actually is a Buffett one, but it's a good one. What is it? The stock market is a vehicle for transferring wealth from the impatient to the patient.
Okay. On that note, thanks a million, everyone, for coming to the webinar. Hope to see you soon.
Thanks for your time today.
And enjoy the weekend and enjoy the weather. Thanks a million.